So what were the mechanisms that inflated the American housing bubble? To understand this, we have to rewind the clock to the early 1990s, when two major developments took place: the globalization of the marketplace and the securitization revolution.
We saw with the fall of the Berlin Wall at the end of the 80s, a doubling of the workforce of the globe. I mean, China, India, Eastern Europe came on stream, and these countries wanted to be like us. They wanted to be like America, and they started to emulate us in their productivity improvements, and they joined the capitalist system.
A move towards global capitalism occurred during the 1990s. Consequently, trade barriers between nations dissolved, multinational corporations grew, and economic interdependence strengthened. Now, more than ever, the competition of production and the investment of capital knew no borders.
Suddenly, there was a global ocean of money, of capital, of liquidity, call it what you want, floating around the world. And for the first time outside our borders. And everything was defined and financed globally. And that was fine, except in the last decade, we were experiencing a phenomenon of too much investment capital chasing too few investment opportunities. So what did the bankers do? Well, they said, look, we can't assess the risk of all these investment opportunities fast enough. So they came up with, it really started in the late 90s, they came up with an idea called securitization.
There's been a lot of talk about big revolutions in our lifetime, the globalization revolution, the information technology revolution. I think just as big as either of those has been the securitization revolution, the creation of new vehicles by which wealth is carried and traded. You know, I guess one story that just hasn't been fully covered is how profound the changes to the global economy have been over the course of the past 20 years.
As securitization and globalization opened up capital markets to global investors, a disproportionately large amount of money began flowing to the United States. This imbalance changed the dynamic of borrowing credit and helped set the stage for the housing bubble.
Reality is that the big investment opportunities are in the developing world. But for various reasons, all the money in the developing world wants to be invested in the developed world.
You have like a planet which is made of people who save a lot, unlike US households. So people outside save a lot, and they're looking for places to put their money. And the only place in the world that was able to say, hey guys, I have actually products that I can sell to you that have decent yields because they are innovative. That was the US financial system, and therefore all the money started flowing there.
All this money coming in from overseas, looking for a safe place to invest. And America was very good. We're very good at enforcing the law and doing all the things that make people pay back their loans usually. So there was just this enormous supply of credit, and people were able to borrow, and so they borrowed a lot.
The money flowing into American capital markets from overseas provided an abundance of easy credit. On top of that, the United States Federal Reserve Chair Alan Greenspan set and sustained unprecedentedly low interest rates in a series of moves to combat the nationwide recession caused by the dot-com bubble bursting in 2001. Greenspan lowered interest rates from about 6.5% to just 1%, making the abundance of existing credit very cheap to borrow.
Greenspan ushered in an era of extremely cheap money, very low interest rates. That was his move to correct the fallout from the dot-com boom.
He's trying to prevent a wealth effect of the fall in the price of stocks. That wealth effect might cause people to spend less, so consumption might fall. Well, let's offset that with strong housing. How do you have strong housing? Well, you keep interest rates low so that mortgages are cheap so that people can build their houses.
Basically, in order to get rid of the consequences of that boom collapsing, he, in effect, caused the next boom, which was a housing boom.
Greenspan's low interest rates encouraged Americans to borrow and spend more. As a nation, we began to spend more than we were making.
If you run a large current account deficit, you have to fund it. You have to run a correspondingly large capital account surplus. That is, the only way you can spend more than you take in is if you issue IOUs. The United States was very good at issuing IOUs. Some of those foreign investors included foreign official accounts, that is, governments. So now you have a situation in which we have a large current account deficit, therefore we have a large capital account surplus, we're counting on foreigners to buy our IOUs, and foreign governments are sucking up all the government securities. What did the private sector abroad do? They asked for synthetic high-grade exposure to dollar assets. What's that? Tended to be mortgage-backed securities that the rating agency stamped as AAA.
Mortgage-backed securities attracted large foreign and domestic investors like pension funds, insurance companies, and municipal governments because they were considered secure investments with good earnings. During the peak years of the housing boom, close to $6.6 trillion in mortgage-backed securities were traded. The investors got their consistent returns, but the real winners were the institutions that issued the securities.
Bankers are not considered brilliant investors. They're just, they're commercial bankers. There were banks that were getting 35% return on equity. That kind of a financial return for an investment, that's kind of like a master world-class trader, not a banker. And you would think that that the regulators would have said, how could this be? How can these banks be achieving these rates of return unless they're playing games? Well, they were.
To understand how these investment banks achieve such high returns, we first have to look at how Wall Street has been regulated over the past 30 years. Since the Great Depression, there has been a polarized debate about the role government should play in markets. On one side is the belief that markets operate best with the guiding hand of government. On the other side is the idea that markets' efficiency and productivity is hindered by government intervention, and if left alone, competition within the market would naturally produce an economy that functions optimally. In 1980, by electing Ronald Reagan as president, our nation chose its side. Reagan championed the belief in markets and effectively withdrew the government's guiding hand. This institutional wisdom helped shape a generation of free market ideologues.
The right wing used to say, it's your money, you know how to spend it better than any bureaucrat in Washington. It was a very powerful slogan.
What changed, I think, was the attitude toward regulation. President Reagan famously said, government isn't the solution, government is the problem. And that attitude, I think, really affected us for the next quarter century.
This laissez-faire attitude was embraced by the financial sector, and Wall Street lobbyists and financial elites put pressure on Washington to deregulate capital markets.
They managed to go to governments and sell a proposition, which was we should be able to self-regulate. We should be able, unlike airline pilots or drug manufacturers or architects, to create a market that is not regulated by governments. You can trust us to do this. We will only be selling our fancy instruments to other sophisticated investors. So if they make a mistake, who's hurt? Just them.
Wall Street became the poster child for free markets. Its entrepreneurial ideas, now connected with a sea of global capital, helped shape an era of prosperity.
Over the last 25 years, we've had the greatest stock market, in history. I mean, we've seen the Dow Jones go from 1,000 to 11,000. This has been great. The value of all U.S. companies went from $17 trillion to $57 trillion over the last 25 years. So enormous amounts of wealth were created, and in some part, that was a result of financial deregulation.
Just as businesses and stockholders saw an expansion of wealth, so did those working on Wall Street. With profits soaring, Wall Street became a very attractive place to work, and the financial sector swelled.
For 45 years, the average wage in finance is equal to the average wage in the rest of the economy, and the financial sector is not very large, maybe 4% of the economy. In the 2006, finance was 8.3% of the economy, and on average, they were paid 195% more. That is 3 times more than their peers. You can roughly estimate that maybe 20% to a third of Harvard undergrads got jobs in the financial sector. You really want to put 1/3 of the smartest kids in America in the financial sector? Don't you think that maybe it's a bit too much, that 2/3 for everything else, the doctors, engineers, scientists, high-tech, programmers, whatever? That doesn't sound something that can stay on forever.
Many of America's brightest were recruited to invent new investment vehicles that would create and transfer wealth, maximizing profits for their firms and shareholders. Critical to this effort was calculating where existing financial regulations had loopholes and shortcomings.
Well, I think the thing to understand about Wall Street that, frankly, nobody understands, and the worst part about it is not even the CEOs and the boards understand, is really what was going on 20 floors below, which was a kind of creative capitalism at work where you had people, very smart people, trying to think up what you might describe as new products.
Complex financial instruments that they'd invented themselves, which were outside of the regulatory framework and outside of the banking framework, and which, quite frankly, they didn't fully understand.